So today, let's talk about something that's right at the heart of our economy. This great mismatch between how the market absolutely loves interest rate cuts and the hidden long-term costs that, well, they always seem to follow. It's a tension that really defines modern finance.
And this is the thing, right? This exact mismatch, where the good news is immediate, it's loud, it's clear, but the consequences are quiet and way off in the future, that is precisely where the biggest market mistakes are born. It's kind of the system's perennial blind spot.
Okay, before we get any further, I want to be super clear about our mission here. This is not about market predictions or hot takes. We're not going to sit here and guess what a central bank might do next month. Nope. Our goal is to give you a structural framework, a way of thinking, so you can understand the unavoidable consequences of these policies for yourself.
So here's the roadmap. First, we'll hit that immediate adrenaline boost that markets just can't get enough of. Then we'll dig into how costs are actually redistributed, not, and this is key, not eliminated. We'll break down the three big structural hangovers that always show up. We'll explore why we're all basically incentivized to ignore the future. And finally, we'll arm you with the right questions to ask.
All right, let's dive in. Starting right where all the excitement begins, we have to lay out the conventional story, the one you hear everywhere, that rate cuts are the ultimate green light. It's like the cavalry is coming to save the day for the economy.
And you know, this narrative is so powerful because the immediate benefits are just so obvious. For regular people, it means direct relief. Your mortgage payments might go down, car loans get cheaper, credit card debt is easier to handle. And for companies, their existing debt becomes a smaller problem and refinancing starts to look like a no-brainer.
And the market? Oh, it reacts like a dog hearing a dinner bell. It's a textbook Pavlovian response. Investment projects that were kinda on the fence, suddenly they get a green light. Stock valuations rally like crazy, especially for those high-growth tech companies. And in the credit markets, spreads tighten, which is just a fancy way of saying everyone thinks risk has gone down. It's a really powerful feedback loop.
Okay, but here's where we get to the heart of it. This is the big pivot in our story. Underneath all that celebration is a fatal assumption. The belief that all these benefits are somehow free lunch, that they don't come with any real structural costs to the system.
In this slide, this is crucial. You gotta understand the difference here. Monetary policy isn't about creating new organic value out of thin air. It is fundamentally an act of redistribution. It's taking a cost that exists today and shifting it somewhere else, maybe onto future growth or onto savers whose money is now worth a little less. That cost doesn't just disappear.
And here's the kicker. The whole game is set up to reward focusing on that immediate, easy-to-measure gain. So the market consciously or unconsciously ignores that deferred structural expense. It just kicks the can down the road until that cost pops back up years later as a crisis that feels like it came out of nowhere. This is the mismatch.
All right, so let's get into the nitty-gritty. Where do these deferred costs actually show up? We can break them down into three distinct structural hangovers. You know, the real price of the party.
We're talking about time distortion, capital misallocation, and the erosion of institutional credibility. And each one is so easy to ignore because its effects are gradual. They're subtle, right up until they become a massive systemic problem. Okay, first up, time distortion. Think of it like this. When you slash interest rates, you're basically subsidizing the present at the expense of the future. This slide lays it out perfectly. A company was going to build a factory in 2026, but hey, cheap money. So they build it now, in 2024. GDP and profits surge. The market cheers what looks like strong organic growth. But what really happened? The economy just borrowed demand from its future self, and by 2027, you're left with a guaranteed hole, a period of weaker growth. That is the economic hangover. All right, hangover number 2, capital misallocation. Now, in a healthy economy, money isn't free, right? That scarcity forces you to make smart choices. But when credit is super cheap, the financial penalty for making a bad business decision gets drastically reduced. In effect, you're subsidizing inefficiency. And this cheap money is what keeps the infamous zombie companies alive. These are firms that aren't really productive. They make just enough money to pay the interest on their loans, but that's it. They can't invest, they can't grow, they just exist. And in doing so, they trap capital and talented people that could be used so much more productively somewhere else. I love this fleet of ships analogy because it just clicks. Imagine the economy is a fleet of ships. In a healthy system, the leaky, slow ships sink. It's sad for them, but it frees up their resources, their crew, their cargo, for the faster, more efficient ships. The whole fleet gets faster. But in a subsidized economy, cheat credit is like giving every leaky ship an infinite supply of buckets. They never sink, so the fleet looks bigger, but its average speed, its overall productivity, has slowed to a crawl.
And that brings us to our third and final cost. And this one is a bit more subtle: the erosion of institutional credibility. When a central bank is constantly flipping and flopping its policy, it doesn't signal strength, it signals fragility. You see, policymakers are under immense pressure to do something in a downturn, and cutting rates is the fastest, most visible tool they have. But eventually, the market starts to wonder, are these guys playing chess, or are they just reacting to every little thing?
And this kind of reactive policy creates something called moral hazard. It's a huge deal. Market participants learn the playbook, take on more and more risk, because if things go wrong, the central bank will probably ride to the rescue. There's this belief in a permanent safety net. And the result? The entire system becomes permanently riskier, even when interest rates look low.
So, that brings us full circle. If these costs are so obvious, so predictable, why on earth do we keep ignoring them? Well, the answer is brutally simple: incentives.
Just put yourself in an investor's shoes for a second. The dilemma is real. On one hand, you have the immediate rally from a rate cut. It's clear, it's quantifiable, and you can act on it today. On the other hand, you have the long-term costs, the future crisis. But that's fuzzy. You don't know exactly when it will hit. And professional incentives, well, they're all aligned with that short-term clarity, not some fuzzy long-term accuracy.
This quote, wow, it just lays it all out there, doesn't it? A fund manager's job, their bonus, is tied to this year's performance. So in that system, it becomes totally rational to be short-sighted. You ride the wave, even if you know it's going to crash eventually. And the same logic applies to politicians, whose success is measured by the next election, not the health of the economy a decade from now.
So, what's the takeaway here? How can you actually use this? Well, the point isn't to try and time the market. That's a fool's game. The real value is using this as a better analytical framework, a way to ask smarter questions and adjust your own long-term expectations.
It all comes down to running every big policy announcement through a new filter. Your own 3 structural checks. First, the time distortion check. Ask, was today's good news just borrowed from tomorrow? If the answer is yes, you should probably adjust your future growth expectations down. Second, the capital misallocation check. Start looking for the zombies. Which industries are only surviving because of cheap debt? And third, the credibility check. Does this policy move feel reactive, like a panic move? If it does, you should probably factor in a higher long-term risk premium. So, to wrap it all up, what are the big takeaways here? 1. Markets price the good news way faster and louder than they price the bad news. 2. Those costs don't go away. They just reappear later, subtly through these delayed structural forces. And 3. Making better decisions isn't about having a crystal ball. It's about asking better questions about the complete trade-off that's happening right in front of you.
And that really leaves us with one big lingering question to think about. Which sector, which demographic, or which future generation is ultimately going to get the bill for today's temporary comfort? Real insight begins when you understand that the cost is always there. You just have to know where and when to look for it.